Welcome to the 3 Edge Week in Review for the week of June 23rd. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here today is Lawrence Jules, Head Trader and member of the Investment Committee here at 3 Edge Asset Management. Now, as we know, there are many different factors that can cause markets to go either up or down, higher or lower. And today, Lawrence and I are going to look at how the market mechanisms behind stock options and something known as gamma trading is helping to drive U.S. equity indices such as the S&P 500 back to new record highs, despite the concerns that investors have currently faced with. Even as stocks have moved through their February high, we are seeing investor concerns play out in real time in the U.S. Treasury bond market, which has recently experienced the biggest outflows of investor funds since 2020, as investors become increasingly concerned about the amount of U.S. government debt and the growing U.S. government deficit, particularly in light of the Republican budget bill currently being negotiated in Congress. And a return of the so-called bond vigilantes would not be welcome news for stocks. So let me bring Lawrence in here now, and let's discuss something that most investors are not aware of, and that is how bullish investor sentiment and the market mechanisms related to call options have helped to drive U.S. equity indices such as the S&P 500 higher. So Lawrence, why don't you begin by explaining to us just simply how a call option would work?
Thank you, Fritz. So call option, a contract that gives the buyer the right, but not the obligation to purchase a stock or an index on such as the S&P at a specific price prior to the option expiration date. The right to buy at a certain price, even if the price of what you're buying is higher than the predetermined purchase price.
Which is what you're hoping for, right? Okay. All right. So now, how about a simple explanation of what gamma trading is?
Sure. So let's start with a definition. So gamma is a measure of how fast the option price will change in response to the change in the underlying assets. And fundamentals are not the only factor actually that drives stock prices. There are more factors impacting market moves today than it was 20 years ago. So to put that into context, think of it this way. The backstory on the option market is the volume of equity options surged nearly 11.2 billion contracts last year, representing a 10% year-over-year growth. And this is according to the Option Clearing Corporation. So option flow can drive stock markets, and that's not always obvious to investors, but at the same time, very important. As option volumes make all-time high, the gamma trade become even more relevant to understand. So to understand the gamma trade, you first need to understand the role of the option dealer. Now, the role of an option dealer is to make markets and collect a spread. Option dealers don't make directional moves. They're not betting on market direction. So that's important to understand. So what is the gamma trade? So gamma is basically the gamma hedge, as it's called, is think of it this way. Each time a dealer sells a call option, for example, that dealer has to go out to market and buy the stock in case that security gets called or gets assigned for it to be delivered. The reason is, well, when a dealer sells you an option contract, you, the investor, bought the contract, but the dealer is now short. So that dealer then has to go out to market and buy that stock. So as the stock goes up and make new strike prices and continue to grind upward, that dealer then have to continuously go out and buy the stock. So the best way to think about it is this. If Apple is trading at $200 and a dealer sell you 100 contract on Apple at a strike price of 200, so at the money, that dealer then has to go out and buy 10,000 shares of Apple. So if the Apple continues to grind upward, let's say Apple goes to $220. Well, that's a new strike price. Then that dealer then has to go out and buy more stock. So basically, as option contracts get traded at record level, this is having a direct impact on the stock market, but also on the individual stock. So that in itself can lead to an outsized move in the market. So think of it this way. It's almost like an artificial movement. So it's not just the fundamentals that are moving the market, because 20 years ago, option volume wasn't so pronounced. And to put that into context, the other thing to think about is today, for example, the top 10 stocks in the S&P represent 36% of the index. In the Qs, the top 10 stocks represent almost 50% of the movement in the index. So if a lot of option contracts are being written on those stocks, a gamma trade, then that phenomenon will lead to more bigger moves in that particular index. So stock goes up, option dealers goes out and buy more stocks, which is continue to fuel potentially the growth of that particular stock. So how much of an index return from the fundamentals of the stock holding? How much of the gamma trade, how much impact does the gamma trade have on the movement of the stock market? Who knows? But I can tell you, as a firm, that's something that we think about. When we look at market valuation, that's something we think about, discuss, and consider as a new method of valuation or another way of looking at valuation. So we think that's something investors should also look at as well. So again, unlike 20 years ago, fundamentals are not the only factor driving stock prices. So that's why the gamma trade is important as an investor for you to consider as you think about valuation and think about returns.
Excellent. All right. So it seems like, so what we're seeing is the growth of the options market combined with this investor bullishness and the market mechanisms that play out in the options market can all contribute to driving the market higher. And I think it's very interesting, the fact that you raised, which is that the market maker has no opinion in this transaction, right? They have to go out and do what they do. But if it's in a bullish call options that are being written, it's going to drive the market higher. So Lawrence, thank you. Fascinating example of one of the factors that can drive stocks higher, and it definitely often goes unnoticed. However, here at 3Edge in our research, as you said, we need to understand, we need to pay attention to a multitude of these types of market moving factors that can serve to drive markets either higher or lower. So I hope today's discussion about a less well-known area of the capital markets was interesting and informative. At the very least, thanks to Lawrence, we can all now hopefully impress our friends and family by discussing the impact of call options and gamma trading on the stock market. So that will do it for Lawrence and me for this week. As a reminder, all our videos are available at our 3Edge YouTube channel, and if you know someone who could benefit from them, please feel free to share them. So, on behalf of Lawrence and everyone here at 3Edge, thanks for listening.